Sierra Pacific Mortgage and our operation. Our office is located on the Mile Ground here in Morgantown, and the alumni that are tuning in, I'm sure know exactly where that is. It's between here and the airport. If you go through the traffic circle, it's right there on the right. Our staff, we're missing one up there, but our loan officer staff consists of Jennifer, Katie, and Amanda. Katie has joined us today. My name is Tom Burke, and I sort of own / manage two branches of Sierra Pacific Mortgage. Just a little background on Sierra. Sierra is a 30-year-old company, founded in whatever, 1986 or something like that. The founder of Sierra Pacific Mortgage is still managing the operations of Sierra Pacific Mortgage. His name is Jim Caffrini. When I say owners, managers of the branch, my wife and I are partners in Sierra Pacific, and we've been in the mortgage business for 20 years. I graduated from WVU in 1983, spent some time as a financial analyst, stockbroker with the firm of Smith Barney, which at the time was the largest privately owned brokerage firm on Wall Street. Spent some time doing a number of other things, analytical instrumentation sales, among other things. And eventually, in 1997, my wife and I founded what was a company called Mid-States Financial Group, private label mortgage brokerage firm in Martinsburg. We aligned ourselves with Sierra Pacific Mortgage several years ago, which is a strategic partner for us. They provide the back end of our business, which would be the products. When you think of products, FHA, VA, USDA, conventional, those are products. So they provide the products, we provide the retail exposure. So it's a synergistic relationship. They do the part of the business that I don't want to do, and that gives us the freedom to do the part of the business that we like to do, right, which is make presentations, be in front of the public, basically sell the products that they have available for us. So that's a little history of Sierra Pacific Mortgage. Wanted to just talk about one of the factors that drives a real estate market is employee confidence, or not employee confidence, but consumer confidence. And right now you can see that the consumer confidence trend is on the rise. I think people are feeling better about the economy. Some may argue that, but I think the economy is in pretty good shape. I think that there are many jobs to be had. I recruit on a daily basis as I try to build our team, and finding good talent is difficult. So I can tell you right now, there's not a surplus of great talent that is looking. Most of the people that I encounter have jobs, which is a good thing. And I think it's that confidence in not just their wages, but their continued employment that drives the housing market, because as the biggest expense you're going to make in your life, probably, you want to feel good about making that purchase. In 2008, for those of you that experienced it, I'm sure you did, the housing market collapsed. And that was because of basically lenders, investors, they were offering mortgage products that just weren't sensible. You may have heard of them. They were called no-doc loans. A no-doc loan essentially meant that with just a good credit score, you qualified to purchase virtually any price house you wanted, because the lenders would allow you to state your job and state your income. Well, that's pretty risky, right? Well, unscrupulous lenders took advantage of that and were promoting their products and their services to people that just by the mere fact that they paid their bills on time had an 800 credit score.
Who saw The Big Short? Has anyone seen that movie yet?
Yeah.
It's pretty much sums it up in a much more comical way, I guess. But yeah.
Well, it was just ridiculous. It was ridiculous lending, and when the home values were increasing so rapidly, And people were using, and as they would build equity so rapidly, they would refinance their mortgage and tap into that equity, because there were folks gaining equity of $5,000, $10,000 a month.
Which is crazy.
Now you think about that. If you have a loan officer who comes to you and says, you bought your house for $100,000, did you know it's worth $120,000? No, I didn't know that. Well, it is. How would you like to have that $20,000 in cash? Hard to turn down, right? A lot of things you could do with an extra $20,000, and you didn't do anything to earn it,
right?
Except you owned a house. So they'd refinance that mortgage, give you the $20,000, but you may have qualified or not for a $100,000 mortgage. Now you have a $120,000 mortgage. Well, your payment has just gone up proportionally to manage that new increase in debt. But that was okay, because a couple months from now your house would be worth $130,000. So as you got into a financial bind, you'd go back to your loan officer and you say, Katie, listen, I'm struggling this month. And she says, well, your house is probably worth $130,000. Let's just go ahead and tap into that $10,000 equity. It's free equity. It's there. You've earned it. You don't know any better, right? So the cycle went on and on and on, to the point where then the values hit a ceiling, and you could no longer tap into equity because there was no equity to tap into. So values started dropping. As an owner of a mortgage company, I remember in 2008 when the phone quit ringing. Anybody who's ever owned a business or expects to own a business, that's a bad day, right?
Yeah.
Right? The phone is your friend, and when it doesn't ring, it's not good. Well, then the values started dropping dramatically, because folks were becoming upside down in their mortgages. And again, some of you have read about it, some of you have experienced it. I experienced it. My house was worth, in Martinsburg, fortunately I didn't have to sell it, but at one point it appraised for $450,000, and then it dropped down to like $220,000. Well, it didn't matter to me, okay, because I never took the cash out of the equity, but I watched the value change that dramatically, and it was frightening. So there was a collapse in the world of mortgage lending about 2008, and it lasted till about 2012. And that collapse necessitated the creation of some new regulatory agencies, one of which is called the CFPB, the Consumer Finance Protection Bureau, right? And the CFPB came out with a whole new set of rules, and those rules mandated that a lender couldn't make a loan to anybody unless they could prove that you had the ability to repay that mortgage. So stated income loans went away. Stated asset loans went away. All the stated stuff went away. And when you think about stated, I mean, basically you're just thinking, okay, I work as a nurse at the hospital, I make $120,000. If it seemed reasonable, that's what was written down on the loan application, and your loan was then approved because you had good credit.
Right.
It was all credit score based. The world for us has changed, and we, and Katie can attest to this, if you apply for a loan with any mortgage company, we ask for and prove, and we have a number of set of eyes that look at the documentation associated with your loan. So we look at, you say you work at Mylan Pharmaceuticals as an example. Well, we verify that you do indeed work there.
Several times too, throughout the entire process.
Right.
Yeah.
Exactly.
And we verify that you didn't quit the day we fund your loan.
We've had that happen before, then you don't get to purchase a house, so.
Yep. You can't quit your job, right? When you apply for a mortgage, go home, get in bed, and stay there, right? Until we call you up and say, meet at the attorney's office.
Right.
The money's there, let's close on your house, right? Now, I'm not suggesting after you close, you do something ridiculous, but on the other hand, we want to make sure that the day we close, you work where you say you work, you make what you say you make, right? You're going to live in the house. You can't just buy it and not live there. Generally, I mean, you can, but that's a different loan. That's an investment property loan or a second home loan. I mean, there's products for that. But this is all verified. And you talk about a paperless mortgage society, it ain't so.
You'll be paper somewhere. You just don't know when they're going to ask for it, especially with a lot of internet lenders. They kind of sell that, but you're still faxing and scanning things. So
there is no rocket mortgage. I'm here to tell you. You've seen the commercials. No such thing.
Right.
So anyway, that's sort of a history of where the mortgage world was and where the mortgage world is. And for those that have weathered the storm, like the fallout of 2008, 9, 10, 11, it flushed a lot of professionals in our industry. They're gone. They're out of it. They shouldn't have been in this business anyway, because it's such an important economic driver. If you think about the housing market, regardless of where you are in the purchasing cycle, the number of jobs created, and this isn't even on the slide, but the number of, well, yeah, kind of related to this one, but the number of jobs that are created in the mortgage world and the housing world is exponential. And you don't think about it as a homeowner, home buyer. You're putting folks to, like when you put a contract on a house, there's the folks that make windows, the folks that make carpet, the folks that supply wood, shingles, concrete, bricks. I mean, you think about all the components that go in, and that puts a lot of people to work. I think statistically I read that one house construction project puts something like 30 people to work.
I think it now also creates 2.5 new jobs per house too.
Is that what it is?
Yeah.
Okay.
So I mean, like 30 people get to work, but then out of that, almost 3 people are getting into the workforce. So I mean, construction is huge.
Yeah, if you've ever been driven by a housing development and see a house under construction, all the subs that are working on that house, it's crazy. And they don't all get along with each other, by the way. So anyway. So this shows the number of homes sold, and we have data. You see that green bar at the bottom. So in 2016, in August, I'm not sure the P and the R decide that, but in the South region, of which I think they've lumped West Virginia in the South region. So you figure West Virginia south to Florida, and then over to Texas. I mean, there's a lot of.
It's a big region.
Yeah, big region. A lot of big cities in that region. But you can see in the South there was 2,160,000 houses. Now, it says units sold, so that a unit sold could be a new construction that was converted to ownership, or it could be an existing home that was put on the market and sold. So I mean, you got to think of it in those terms. But that's a lot of houses, and that's a lot of jobs, and that's a lot of people, and that's a lot of money. And you multiply that number, the average price of a home across America in the South, in that region anyway, is, I'm guessing, maybe 175 to 225. It just depends. I mean, there are markets where you've got $1 million houses, there's no question. But on a bell curve, those houses, they're outliers. I mean, the meat and butter, house price and value is probably one. So anyway, you multiply that number out, and it's a big number. So that gives you an idea of the economic driver that the housing market is to our economy and our world. What's next? This is interesting too. If you look at the 2005, 6, 7, 8 market, people were extending themselves well beyond their means to buy a house. And that goes back to our previous discussion, which was because you were building equity so rapidly as values were increasing so quickly, that you borrowed more and more against that. So the percentage of your income that was used to pay that housing payment increased. So we call that house poor. What we tried, we're consultants as much as we are lenders.
And I've noticed too, just because I pre-qualify someone, for $400,000, people are much more, a little bit skeptical, I think, with spending their money or all of their money. I think the recession taught not only lenders a great lesson, but also people that are buying homes a great lesson. Like, this is actually what I really feel comfortable paying, not that I need this huge, beautiful home. I mean, of course, we want you to buy a huge, beautiful home, but only if you can truly afford it. So I think that's big too.
Yeah, it's very important. For instance, we call it payment shock. say you're renting a house for $600, but you're right out of college, just got a great job, you're making $80,000 a year, life is good. Well, we can, through the guidelines, qualify you at a 28-29% of your gross income would be qualified. You divide that by 12, right? Would be as much as you could pay on a monthly house payment. So let's use $100,000 income. So 28%, that's 28 grand. Divide that by 12, and that would be the maximum that we would allow you to spend on a house payment. Well, that'd probably buy you $300,000 or $400,000 house.
That's a lot of house for your first house, and it's a lot of payment for your first payment too, especially depending on what state you're in. I know, WVU has a lot of DC grads and NYC grads. Those taxes are New Jersey taxes are also out of control. Here it's a little bit different, but you also have to take that into consideration in your housing payment as well, with your homeowner's insurance and maybe your mortgage insurance if you're not putting 20% down. So that's a lot of house right there.
Right. Now keep in mind, we're basing your qualifications on gross income. We all know there's
Not taxed,
the
right?
tax man is going to take, but that's factored into this. All right. So, and generally these guidelines are created by Fannie and Freddie, and that's a name that many of you have heard. If you don't know what Fannie and Freddie is, they are outlets for mortgages, and I'll just give you a brief explanation of. Fannie Mae was created after the Great Depression of 29, is that what that was?
Yeah,
It was a long time.
30.
But yeah, because banks, we've all seen the movie It's a Wonderful Life, when all the people run into the bank and they say, I want my money, and Jimmy Stewart says, what's not here? It's in your house, and it's in your house, and I've lent Katie, the money's not here, we've lent it, but we're getting it back in the form of principal plus interest. Well, mortgages, being the significant driver of our economy that they are, banks had no outlet for. They had lots of accounts receivable. They had lent a lot of money for people to buy homes, but all that money is now gone. So the Fed created Fannie Mae, which is not a federal organization, but it's federally backed. So the Fed guarantees Fannie as much money as they need so that they can buy mortgages from banks. So if I'm a bank and I've got $1 million in cash and I lend that out to 10 people to buy a $100,000 home, my cash is gone, but you're paying me back, you're paying me back, you're paying me back. Kind of makes sense? But it's not enough money for me to make more mortgages. So if these mortgages are qualified and if they meet the Fannie guidelines, that's what we call a conforming loan, it conforms to their guidelines, we can reach out to Fannie Mae. This is a very simplistic explanation, but it's kind of how it works. We can reach out to Fannie Mae and say, I've got $1 million in mortgages. They all meet your guidelines. I'd like to sell them to you. And then Fannie will give me my $1 million back and perhaps a premium, like a profit, in exchange for the interest that they're receiving against these notes that I have just sold them. Now I've got my $1 million back, and I can go out and make more mortgages. Well, that's called the secondary market. It's a term you'll hear more and more and more, but now hopefully that makes sense to you. When you hear it, it's not just a word. It's like, oh, okay, so that's the secondary market. Anyway, going back to that one slide just a second. I think I was going somewhere with this. Not that one. The consumer. Going the wrong way.
Oh, you want me to go forward?
I'm sorry.
That's okay.
I was going back to, the percentage of, go back. Okay, so the percentage of income. So this whole discussion about secondary market kind of started with this right here, where we're talking about the percentage of income available to spend on a new home versus a sensible amount of income you feel comfortable spending on a new home. And that's a significant distinction. So before the crash, people were spending as much as they could, because who doesn't want to live in an 8,000 square foot house? We all do kind of once, right? Maybe not until you start to clean it. Then you're like, never again, right? So anyway, so the American public wised up. you know, and they said that, you know, we can't let this happen again. The CFPB put, you know, measures in place to prevent this from happening again. And I think, you know, consumers said, I don't want to spend all of my disposable housing income on a house. I want to go places. I want to do things. I want furniture. I want more disposable income. Well, if it's all going to a mortgage, you know, you don't want to be broke at the end of the month. What fun is that, right? So anyway, that was kind of the point of the kind of a disjointed discussion here, but I'm trying to get you guys fired up.
Wake up.
This shows just the volatility in interest rates, but you know, for those of you that, you know, have been in the housing market, you know, you're very sensitive to this. For those who may want to buy a house at some point, you should be sensitive to this. In my lifetime, I've seen mortgage rates from 15% to where we are now, which is generally, I've seen them as low on a 30-year fixed rate mortgage. I've seen them as low as 2.8%. And for anybody who's in business and economics, if any of you take those classes, that's almost free money, because you get an interest deduction, which then, you know, so the effect of a low interest rate with the interest deduction that you get brings your effective cost of money to between, you know, 1.5 to 0. I mean, it's nothing, right? So anyway, right now, as you can see in 2016, we're in a very low interest rate market. Yellen, you guys have maybe heard that name. She's chairman of the Fed. When she speaks, the world listens. Honestly, she's very powerful, because when she suggests something, it affects the global market. It's amazingly powerful. So that's why you don't hear her saying much, right? She's not on stage debating, right? They meet behind closed doors and they discuss financial policy, and she suggests we might have to raise rates by the end of the year. Now, what the Fed controls is not mortgage rates. A lot of people think they do. They don't. The Fed controls the Fed funds rate. I think it's the Fed funds rate. There's like three major. There's the prime rate, Fed funds rate, and there's another one. I think it's the Fed funds rate. But it's the rate that the Fed lends to big banks. And it's an overnight rate. These aren't 30-year interest rates. These are overnight rates. So if a bank like Wells Fargo is short on cash, because big banks are regulated by many agencies, the OCC, which is the Office of the Comptroller of the Currency, and the FDIC, et cetera, and they have to maintain a certain liquidity on their balance sheet, or the Fed steps in and says, you're putting your depositors at risk. People that have CDs and savings and all that stuff, you're putting that money at risk because you're not liquid, right? So Wells Fargo could then approach the Fed and say, I need to borrow a couple $1 trillion overnight to make my balance sheet right, and then I've got money coming in from this to offset that, and I'll pay you back. And that rate is real low. It's less than one, it's like 0.25% or something. It's really low. So how does that affect mortgage rates? Well, money's like apples. There's a margin, right? There's a profit. People want to profit on giving you anything, right? No matter what it is. Money's the same way. Well, mortgage rates tend to move lockstep with the other interest rates that you hear about and read about, whether it's the Fed funds rate, whether it's the prime rate, whether it's the bank rate, blah, blah, blah. So anyway, you do see some movement against what the Fed says, but eventually a mortgage rate, there has to be a market for that mortgage, right? So this gets into the marketing side of finance. So if we're making loans at 4%, our margin is good relative to Rhonda, who's making loans at 3%, right? However, you're making more mortgages, but I'm making more money, right? So there's a balance there. So anyway, that's a little bit about interest rate volatility, and I know that's exciting stuff, isn't it? Anyway, and here we have Yours truly and my good friend Dr. G. You guys know him, right? You ever heard of him? Give you guys some puppy uppers. You guys ever watched Saturday Night Live? They had the two dogs. One was jumping around like a Jack Russell, and they gave it doggy downers. And the other one was laying in a corner asleep, and they gave it puppy uppers. A long time ago. So the mortgage process, I'll let Katie talk about this.
Okay, who here has bought a car? Who here has a car, has had to deal with a car loan before? Okay, only a couple of you. How about buying a house? Okay, how many think you know what buying a house is like? Anyone? Okay. So basically, most people think they go out and find a realtor first and start looking for a house, find the perfect one. You're wrong. First, you need to go to a bank. That's the first thing you need to do. Or us, you know, that'd be better. But basically, you'll need to bring a pay stub. We'll get you pre-qualified off of your exact income amount. Some places still, like, off the pre-qual process, we'll just ask you what your income is until it comes time to make loan application, which could really backfire and hurt you in the long run, especially if you have student loans, depending on what product you're in. Those student loans can have a different payment amount. So say you're $40,000 in student loan debt. Basically, we would have to use $800 a month as your student loan payment, even if you're on an income-based repayment plan or anything like that. It's kind of, it's hard for a lot of students to get houses because of those reasons. So that's definitely something that you want to pay attention to. So after you get pre-qualified, that's when you go and start looking for homes. Find the perfect one, make an offer on it, get a contract going. Then we would help you make application for the loan. You bring in your entire, we'll give you a checklist of all the documents you need. So it's also very important that, especially students, whenever you don't have 2 years of work history, you need to have your college transcripts. They're not going to look at your grades. They just want to make sure that you've done something for the last 2 years, that you've been employed, even if it was as a student. So after that, then we submit all of your information to processing. Processing will scrub the file and make sure that everything looks good to go to underwriting. File goes to underwriting. Basically get approved or denied, and then we can set your closing date. And that's kind of just a watered down version of the whole process. But how long do you think it takes to purchase the home? Anyone? A year?
I don't know. Well, are you talking from
the start of the purchase, the contract, until it's time to move in?
about 3 months?
Okay. That's if you're working with certain financial institutions, just saying. But for us, it takes about 30 to 45 days. The longest part of the process is ordering your appraisal because we have such a shortage of them in this area. But that can get your clear to close. You get to move in the day you close on your home. And for those of you who are unsure about how expensive a house is, I will tell you that if you buy a $150,000 house in Morgantown, you're probably looking in between an $800 to $900 a month payment, which is much cheaper than rent. So you can save yourself a lot of money.
Well, and I'd like to point out, Katie was a renter before she joined us, and now Katie's owns one house, is moving to Pittsburgh, where we're opening up another office of Sierra, and so she has a tenant for the house, and she's purchasing another house in Pittsburgh.
And I'll say I found a house in Morgantown with a swimming pool, attached garage, and my payment was $600 a month cheaper than my rent. And I was in a 2-bedroom townhouse prior. And now I have renters, and it's instant income, and they're paying down my mortgage. Now I can buy a second home and setting myself up for retirement too. So purchasing a home is very smart if you can do it. I highly recommend it. And there's 100% financing products out there for veterans and for anyone that has a household income under $75,000 a year. So a lot of students would be, eligible for that program as long as their credit was where it needed to be.
And some of you may not have thought about it at this step. Okay, so going around the room. Are you a student here?
Yes.
What year?
Grad student.
Yes, you couldn't leave, could you? It's hard. It's
What's
hard,
your
I
major?
know.
Sport management.
Okay.
We're in the same program.
Okay.
Yeah, we're in the same boat.
Okay. Where are you going afterwards, have you?
Hopefully south.
I get it.
Taxes are low down south, so you can get more bang for your buck.
Hopefully south.
And what are you?
I'm from Michigan, so I'd like to get back up there, but we're about to find a job.
Okay. Oh, you work here?
I work here. I just graduated. I'm in my like 5th month here,
Okay.
full time.
Were you a broadcast student?
I was a broadcast student.
So you've had Dahlia before?
I had Dahlia.
I did too.
Yeah.
That's why
and
you're a good employee.
I did my master's degree here.
Okay.
And didn't expect to do that, and then stuck around for a full-time job here. Didn't expect that. So
I'm like, okay, well, I'm not leaving.
It's tough. Well, one of the reasons that we have this office in Morgantown, I graduated, as I told you, I graduated here a long time ago. We all have our war stories, so I'm going to tell you a couple funny ones. I was living on the mile ground. My roommates at that time were a guy named Dave O'Black, who played football here, a guy named Charlie Costin, who bought and built Crockett's Lodge. So I was one of the original nail pounders as they rebuilt. Crockett's used to be called a bar called the Cottage, and it burned down. Not sure if it was accidental or not, but the four owners, I think, were tired of the bar business, and it was a seedy place. Like the bathroom floors with like this. They still do. Oh, honestly you thought you were gonna fall through. It's like, okay. Anyway, and when I was in school here, Mike Pushkar was just getting Milan off the ground. He had tapped into the generic drug market. I think, and I may be wrong on this, but I think Bayer Aspirin's rights to the patent were expiring. And I believe that was Milan's first step into the generic drug industry. So, over the course of all this time, my love for WVU has been strong. I'm a season ticket holder. I'll be here this Saturday. I have friends coming in. The director of our retail development division is coming in Saturday. He's a TCU fan. He's got kids that go there. So that'll be fun. My daughter is a senior here at WVU, and what's kind of interesting, I was talking to Rhonda, the school has a program now that you guys have all, I guess, have taken. It's sort of an intro to college life and the do's and don'ts of being here. They didn't have that when I went to school here. They didn't have much of anything. I mean, it was here, but I think our enrollment when I was in school was like 8,000 people.
Oh wow.
The stadium at downtown was still a football stadium, back where the B&E school is. I mean, it was you could drink in the street. It's pretty cool. all the bars on Sunnyside. If you were going, they asked you, "Are you going out?" And if you were, they give you a plastic cup. If you were in, you had a glass. And so, bonfires. I don't want to say I participated, but it wasn't against the law, right? The cops would just watch it burn, and when it burned out, they would clean up the ashes, and no one got arrested for that kind of stuff, unless you got rowdy. But who got rowdy? It was a fire. It was fun. But anyway, I just sort of a walk down memory lane. But speaking of my daughter, who's a senior here, and when we went through her orientation, and they talked about all the things that if the kids would get involved in, like the rec center, that was the big thing. Go to class is probably a good idea. Open your book once in a while. That's probably not a bad idea. I wish they'd have had that when I went to school here. It took me a couple of years to realize when you pull that cellophane off, there's a world of information between the, right? Guilty as charged. But anyway, WVU is a great institution. Lots of fond memories, but where WVU has gone, has become over the years, is just fascinating, and I think it's something that we could all be proud of. I mean, it's a great school, and what you'll notice in your careers, West Virginia is a small town. Everybody knows everybody, honestly. It doesn't take a few questions of do you know, and finally, it doesn't take long to make a connection, right? And then the stories begin, and you realize, gosh, I'm glad I went here. But anyway, that's kind of I don't know if there's any, do we have any more slides?
Oh yeah.
Products, okay.
Oh, yeah.
I'm sorry. I get off on tangents. My office has to listen to it all the time. But they've learned to walk away from me. Those are the bread and butter products that are offered in the world of mortgage lending. People think that FHA is a federal loan. It's not. Federal programs are merely insured by the federal government. So it's an insurance policy. And that makes loans very attractive to investors. Investors buy mortgages, you know. But that, and again, that's the secondary market that I talked about earlier. So your three primary federally insured mortgages: VA, USDA, FHA. The list up there are streamlines and some other you know, sort of variations of the same product. Then you have Fannie and Freddie, which represent the first or the initial secondary market investors, you know, created after the Great Depression. And loans that would be sold to Fannie and Freddie are conventional, and they're all conforming. So Fannie and Freddie don't buy jumbo loans. So, and jumbo is defined as a loan over $417,000. Fannie doesn't buy those. In other words, their sweet spot is very specific. You know, good job, good income, $417,000 or less. Some down payment. They want some skin in the game, you know, from the borrowers. Jumbos, there's a whole different investor group out there that buys jumbo loans. What comes to mind is Transamerica, big insurance company. You've seen the pretty building out in San Francisco. It looks like a cone, sort of. They would be like, we would call those an institutional investor. So they buy loans.
And I do want to point out real quick about the jumbo products. I don't know how many of you plan on buying homes above $417,000. I would like to someday, and then I will have a maid to clean it, because you were joking about that earlier. But just because it's not conforming to Fannie or Freddie, don't think that means that it's an easier loan to get by anything. I mean, they probably look at you with more scrutiny than, you know, if you were buying below that $417,000 purchase price. I just did one actually that closed last Friday. And the borrowers had excellent credit, almost 800 and over $1 million in assets, and it was still a lot of effort from them, just because, you know, it's such a high risk loan. They consider it because of the purchase price, even though they're obviously more than qualified to purchase the home.
And then we've all heard of ARMs, adjustable rate mortgages. Essentially, they designate, 1-1 means that for the first year, your rate will not change, and then after the first year it can change based on certain underlying factors. The 3-1 fixed for 3 years, then every year after that it can adjust. 5-1 fixed for 5, and then it can adjust. Why would you use an ARM with interest rates at the 3.5% to 4% range? You wouldn't.
I mean, I don't
no reason.
sell them to people really, you know, especially if they're planning on being in their home for beyond the term period, and there's no point in doing it.
In my 20 years of being in the mortgage business, one hand the number of ARMs that we would sell to people. Where those are popular, just in case you're curious, high dollar markets. San Francisco is a good example. Probably the median house price there is $1.2 million, and an ARM is generally starts out less than a fixed rate mortgage, right? Because it's risk. It protects itself against interest rate risk. So say you borrowed money to buy a house on a 3-1 ARM, your rate might be 3.25%. I'm just making up numbers. Might be 3.25%, and then our economy, something happens, something ugly happens. Could be anything, and rates jump up to 6%, right? Because of the volatility in the world markets. Well, the person who lent you the money at 3.25% for 3 years knows that after that third year, they can at least increase the interest rate to offset the margin that their competitors are getting at 6%. Does that make sense?
Right.
So that's why ARMs are popular in certain markets. West Virginia, no reason to ever get an adjustable rate mortgage. I'd rather tell people, for the next 30 years, if you stay in your house that long, this is going to be your payment, and it will never change. You know, that's pretty comforting, I think, when you guys eventually own a house. You'll get a house someday. You'll start looking. You get that great job right out of school, and you'll be like, okay, now what? It's exciting. I'm interviewing for some folks up in Pittsburgh, and I talked to a girl yesterday who, she had to go to New York. She's a WVU grad, she had to go to New York, get that out of her system. So she went up there, was paying, I think she said $2,500 a month for a flat.
Oh my God.
Right? I mean, it was, you know, even though the money is great in New York, the cost of living is yes, it's just ridiculous. So anyway, she moved back to Pittsburgh, and now she's paying $1,500 a month in rent.
Oh my gosh, but still
And I
out
was
of
talking to her,
control.
and I said, do you realize, I said, for $1,500 a month, I said, you're in the $300,000.
Well, with PA taxes, like 250, but still, principal and interest, you're looking in at 300,000.
Well, and if you get a little bit further away from the city, you know, depending on where you get, you know, I mean, obviously, if you're downtown Pittsburgh, you know, you're gonna pay premium, especially to own. Anytime you own in a city, you're gonna pay top dollar. But bottom line is, think of what you know. I don't care what state you live in. You know, $150,000
You're saving money,
house.
you're building equity.
That's a lot of houses in that price range, right? That you can find.
Nice
So anyway,
houses.
it's just interesting. Another interesting thing, we had, how many WVU employees work for us? We have 18 employees. You,
So many, Denise.
Jordan, Amanda, me. My wife's a Towson graduate, but she's a convert. She went through the classes, right? She was blessed at WVU. In Martinsburg,
You're
maybe.
Denise, what about Jeff?
Jeff's shepherd.
Oh, man.
He couldn't leave home.
We have a lot,
Yeah.
basically.
So, but anyway, you're talking about moving south? Charleston, South Carolina. I want to open a branch in Charleston, South Carolina.
Heck, if you do that, I might move again.
Just so
Yeah.
you know, plant that seed. I wonder what these people watching on podcast are thinking. Anyway, you should be here. This is where the action is.
Especially with the game this weekend.
But yeah, Sierra has no office in Charleston. And I thought, that might. They call them halfbacks. People that live in the Carolinas. They moved to Florida, way too hot, so they moved halfway back.
Oh, okay, I get it. What a weird joke.
Right. That's what they say. Anyway, do you guys have any questions? Was this interesting? Was it, you know?
Yeah, so do you recommend to own as soon as possible? Is that?
It depends. Find out where you're going to be.
Yeah.
You know, I mean, don't jump into a house because it is an obligation, and
Right.
it's an expense. It's an obligation, and it shouldn't be taken lightly. You know, if you get a great job, if this is where you're going to be, you know, and you're comfortable, and you know your income's going to be steady, and you know that you're going to be, you know, on a track, you know, to always be doing better. Think about that. You know, I think owning is, with the benefits of owning, I think it certainly offsets the rental aspect. I mean, if I'm your landlord and you're paying me every single month, you know what you're doing? You're paying my mortgage.
And then you're paying my retirement.
Yeah.
Thank you.
Yeah, and I'm obviously charging you rent that I'm going to make a profit on you, ideally. And if I keep the place nice, I should keep it rented all the time. I mean, if it's
And then rent
a
goes up.
slum, that's a different, you know, that's not what I'm talking about. But you understand what I'm saying? You know, so you're just making your landlord ultimately wealthy, you know, or at least you're covering his liabilities. I mean, when you own your own house, it's your house, it's your dirt. Now you've got to pay taxes on it, so it's yours until you quit paying taxes. But you know, yeah, I would certainly consider it.
I would say 7 years is what you want to shoot for to be in a home. Most people move in 7 years. If you're going to be there for 7 years and you're not having a down payment, then yes. If you're putting down money, then you can turn around and sell it for a profit or rent it out pretty much instantly, you know, especially in strong housing markets. That's another thing you have to look at which market you're in. Martinsburg, Morgantown, Pittsburgh are all very strong markets. I mean, business is booming. People want to come here. Towns are growing. When you have that, I mean, you have a demand for, you know, purchases. Houses in Morgantown go up 3% every year. And rent goes up probably even more than that every year. So even if you're like, oh, I bought a house, but now I got transferred from my job, do what I'm doing. Rent it out, buy another one.
Or you could easily sell it.
Right.
Yeah.
I just choose to keep it.
There's a couple rules of thumb in life. Don't fall in love with a house, right? It's not emotional, right? People get very emotional about property. You know, try it. Not to suggest you don't love your house, but the thing is, don't love something that can't love you back. All right, and don't buy something you can't sell. And we see that often. People come in and they want to buy this house down by this shed down by the river because they really like the river, wherever that river happens. Doesn't matter what state you're in, but they got to be by the river. Well, You got flood insurance, right? You've got, I mean, look at the people in the floods in Greenbrier County, right? I mean, as awful as that is, many of those folks loved being by the river. And I get it until until a tragedy happens, and I'm telling you, I can assure you 90% of those people did not have flood insurance. You know, and it's awful. It really is awful, you know. You know, just something to think about. You know what I mean? I mean, I'm not suggesting these people did anything wrong. That's not at all what I'm saying.
Right.
But you know, be aware of where the house is. Look at the marketability. Look at the structural integrity. You know, make a sensible decision. Because you can.
Home inspection is everything. Appraisal is everything. You know, really look at those reports when it comes time to purchase. The appraisal will tell you if you're in a flood zone and what the comparables are, if they're going up or if they're going down. And if they're going down, I would say you probably want to look in a different neighborhood. I have a guy right now that's trying to refi, and he bought his house 2 years ago for $110,000. It's now worth $90,000. He thought he was getting a good deal, but the neighborhood that he's in and needs some gentrification is actually in Pennsylvania. But he's out now, $20,000, and can't refinance, can't do anything. So.
And I think we're pretty good at helping you. You know, like I say, we're not licensed appraisers, but a licensed appraiser can certainly establish value. You know, but anyway, I mean, those are just practical, sensible, discussions you have or thoughts you have to have going into the process.
So when you said that you suggest 7 years, or I don't remember what the other number was, that you're going to be in a house, is that how long it is to build the equity back to be able to sell at a profit?
No, not necessarily. Basically, even if your home was flatline in value, I say that because I've done the amortization schedule. Like, that's just when you start building equity in it. If you do 100% financing to a point of where you can sell without, paying because real estate commissions are typically 6%. So you want to at least have that value in there and a little bit of cushion for some other fees that you're going to pay if someone wants to buy your house, and that's why I said 7 years. Yeah.
And the flat line is the operative word there. If you
It goes up, then
if
it's
you're appreciating, like, what's the rule of doubling? There's a rule.
I don't know.
I forget the rule. But if it's appreciating at 3% a year, it's $100,000 house, it's 103, and then 3%, and then compound that 3% over a certain amount of time, and that gives you a rough idea of the equity if you had to sell.
Okay.
If selling isn't, you don't buy a house thinking about selling it. That's not a good way to buy a house, right? You buy a house thinking, this is where I want to live for a long, long time. Things happen and you want to sell, but just make sure you can sell it for as much, as you pay for it.
Right.
Right.
Maybe not having to bring your, real estate commissions and whatnot. But Morgantown, I've never seen a house depreciate. Honestly, we were protected from the bubble even. Things slowed down a couple years when I was living here in 2009 through probably 2011. But I mean, now any house that's under 250, you're going to be in a multiple offer situation. Typically the houses are selling for over asking price because of that multiple offer situation. People are competing. So I mean, it's a very strong, vibrant market here. So usually you don't run into that situation, but Las Vegas got hit pretty hard, Florida, so forth.
So there.
So do you guys have a lot of people come to your office who are just recent grads and are thinking about buying a house?
I'm working with a girl right now that's a recent grad. She thought she had terrible credit. We pulled her credit. It's actually great. She is searching for a home with 100% USDA financing. So she's going to do that and continue on working. I think she's a doctor, maybe doing some residency and still in school. But you don't have to be making a ton of money to buy a house either. We have people with $30,000 salaries and even lower that are buying homes.
Now, and to expand a little bit on that, if we're not a credit repair agency, okay? However, we would be happy to discuss with you your home buying qualifications from a credit standpoint, right? Because you haven't found your job yet. So I mean, it's really hard. We don't have an income that we can plug in there. We don't have a job history, that sort of thing. But if you wanted to come to us and talk about, credit requirements you would need to buy a house. We'd be happy to do that. And then when you get close to maybe buying a house, we could actually run your credit. And I want to let's talk about that for a second. The credit bureaus that we draw from, they're the three major, they're Experian, TransUnion, and Equifax. Those credit agencies, all they do is they collect data and they put that data into an algorithm that generates a number. Now here's what you don't know, and I didn't know this, I kind of knew it, but I really know it now. But these agencies they're not agencies, but repositories. They've got hundreds of algorithms. And the algorithm that they use to generate a number depends on the industry that's subscribing to them, because they pay them for this information. So for instance, when you go buy a car, the algorithm that they may pull just one, they call them an in-file. So say they send your information to TransUnion, and they say, Rhonda's coming in to buy a new, Lexus, and they put the information in, and they give you back a number, and they say your credit score is 680, and you think that's your credit score. Well, the credit score with a mortgage company might be a completely different number.
Car insurance, different number. So Credit Karma, for example, is a soft pull app. I use it to monitor my credit, but I'm purchasing a second home, so I just pull my credit again, 30 points off.
Yeah,
from what the mortgage scoring module is.
Right.
And I was like so excited, and then I was so bummed. But I mean, it was still good, but it just wasn't as good as I thought it was. But
well, the sad thing is you get the TV, right? TV's a killer. It says, call Credit Karma, it's free, or freecreditreport.com. I mean, there's all you can get. Your credit report is free, but the number that you have to pay, like if you put in your information, you have to pay for the number. I don't know if you guys knew that or not. You have to actually pay them. Your credit report's free, so it tells you your history. Like you have a charge account with Sears, and a charge account with Capital One, and a car loan with Toyota Motor Credit, or whatever. So it gives you all your debt. It gives you the loans that you've paid off. Like if you had a car loan, you paid it off a couple years ago. It gives you all your credit history up to usually 7 years. And it tells you if you've been late, if you're current, so it gives you all that information, but it doesn't give you the number. You don't know that. And then you fill this out, it's free, and then you say, do you want your credit score? And if you say yes, it's like 25 bucks.
right.
Well, that's fine, it's cheap. 25 bucks, anybody can cough up 25 bucks, typically. But that score is not going to be at all what you're going to get when you come to us.
Or when you go to buy a car, because they're using a different algorithm too.
Yeah. So if you really want to know a true borrowing credit score, you should get a mortgage credit report. Now, again, we don't just provide, you just don't come in and we just run credit just to see what your credit's like. Okay, there's got to be a household reason to run your credit, or we could get in trouble because that's not the business that we're in. You know what I mean? But just be aware that going to Credit Karma isn't giving you what you really need if you're thinking about buying a house. That makes sense? Yeah, it's kind of a lot of blue smoke and mirrors out there, and
Credit scores are fickle.
Yeah.
It's a weird thing, and you think you learn it, and we've sat through seminars for it, but then you still have so much more to learn. Like I could go to Credit Karma college, or not Credit Karma, but credit agency college, and still probably not know everything. That's how many algorithms are out there.
it's a bunch. So anyway, something interesting about credit.
Any other questions? Thank you guys so much for having us today.
Thank you.
I hope this was